Welcome back to another Financial Streams podcast. I'm Josh Kozis and I'm here with Michael Harvey. Thanks for coming in.
Hi everyone.
Bit timely, federal budget's just happened, so we thought we'd give you a quick summary on some of the high level items. Not sure about you, Michael, wasn't overly thrilled with the results. It's kind of a 1%ers budget this year, I guess 'cause it's an election year, but we thought we'd at least cover off on what some of those 1%ers are. Naturally, we start to think about the clients that we have and how it might impact them, so we'll do a quick summary.
Yeah, sounds good, Josh.
Excellent. So I suppose the top line item we want to go through is just the changes to tax rates. So I guess they're going to change the threshold. Everyone knows, or most people should know, up to $18,200 a year is tax-free. And at the moment, any figures between $18,201 and $45,000 at 16%. And that's being dropped by 1%.
So I suppose the important point, just because we do have a progressive tax rate system for individuals, meaning that the percentage tax that you pay on every dollar you earn above certain brackets is at a different rate. So above 45,000 gross income per annum is 30 cents in the dollar. So there's no change in that. What they've announced is a change in the bracket, as you said, from 18,201 to 45,000 with a proposal that will reduce by 1%, as in like from 16% for every dollar you earn above 18,201 down to 15% from 1st July 25. So kick off from your first pay packet in July this year, and then another 1% coming down from 15% to 14% 12 months after.
Yeah, I suppose there are a lot of figures and percentages and things thrown out. I suppose for the average taxpayer, what does that likely look like in terms of tax savings?
Yeah, so I suppose the headline that you might have seen in the news and things like that on your feeds is the average income earner is $79,000 gross per annum, and so effectively 1% not on their total gross. So we're only talking about the band between 18,201 and 45,000. So 1% of that is worth about $268 per annum. So around that $5 per week. So you know. So it's never say never, but it's not the some of the headlines grab the attention, and some of the information you might see is that obviously the government spin, they're in election mode, even though the election hasn't been called, is they're coupling that announcement with previous announcements that we actually are getting now, which is the reduction in some of the other brackets that they've done for tax cuts for individuals. And so some of the headlines pick up the cumulative effect of actually enacted legislation and tax cuts as well as pronounced. So some of the ones, I think we were just Googling before, it was like $2,500 to $3,000 is the total saving per annum for someone. And I suppose that's not incorrect, but it's the new announcements is a very modest cut.
Yeah, I suppose as we said, so it's just those little 1%ers for people, nothing that's majorly going to move the needle when you talk $268. But I mean, for a couple, if that's going to be in your bank account at the end of the year, that's still a win.
Yeah, no, it's better in your bank account than the tax man. So
yeah, absolutely. So that was I guess the personal tax cuts. Next thing is on, I always call it HEX, that's the generation I was in, I guess it's Help Debt now.
Yep.
So a 20% reduction in the balances due on Help, that's a pretty significant when you start to look at how much debt there is on that in Australia.
Yeah, this one is actually a significant announcement in my view, especially from younger people wanting to get ahead in life. For two reasons. Obviously, it reduces their total debt by 20%, which is a substantial amount. And secondly, it does give them borrowing capacity. So at the moment, you rock up to a bank with a HEX debt. They'll take that HEX repayment into account in your serviceability, ability to borrow and repay. So effectively, they're given a 20% increase in your serviceability calculation.
Yeah. I suppose from a repayment perspective too, there's also the incentives there to say they're going to be reducing or increasing the threshold until you need to make repayments as well.
True. Yeah.
So all that does come into that lending side of things.
Yep.
There's also been, I guess, talk about the Help to Buy scheme as well. So the government has different incentives to help people get into the market. You might have read some headlines around how they're trying to restrict, I guess, international investment into existing dwellings. So not necessarily stopping it from new developments, but all of those things in conjunction with the help debt is likely to help people wanting to enter the market and how to get their first home.
Yeah, you mentioned Help to Buy, limited knowledge in Tassie. I think Bank of Us is the provider that people has got been contracted by the government to assist people. So essentially, that's another model under the broad umbrella of affordable housing, where the government takes an equity position in the house compared to other schemes where it might be a guarantee by the government on a deposit or something like that. So, Help to Buy, and they've changed some of the parameters. I'm not overly familiar with the detail.
No,
on
I'm
that.
not either.
So, but it's just another one for as you said, serviceability for younger people, reduction in the help or HECS debt, as well as some other options might worth exploring. The home ownership option for people. I think that the HECS adjustment was from 1st of June 25, subject to legislation. I think that was the detail. I think
that's good key actually. There are some of these things that have been discussed that aren't legislated yet. Other ones are going to happen, so it's just sifting through some of that. It's early days, and I guess we've talked about reduction in tax cuts, reduction in potential help debt repayments and how that affects things. I guess other cost of living benefits that have been announced would be around the PBS or pharmaceutical benefit scheme.
Yeah. Yep.
So the maximum that can be charged as part of that prescription. So that's going through. So again, only 1%ers. I'm just looking at some figures here. So maximum co-payment is going to decrease from $31.60 down to $25, and that's per prescription for each individual. So
yeah, I think that comes under the bulk billing as well. Like if you're going to see a GP, what the gap or the amount you pay under that arrangement will come down from 1 January 26, as you said. So as I said, 1%ers, every little bit counts. So.
Yeah, and the goal is, I guess we've read headlines around that the intent is to try and get 9 out of 10 GP visits bulk billed, whether that comes to fruition or not. Yeah,
that's right. That's the headline from the government promotion or their press releases. So
sure, and we are in a election year, so there's a fair bit going on. Yeah. I suppose the other one's the energy relief. So they've done that in the past. Talk to us a little bit more about the energy relief.
So what we understand, some additional rebates available for both small business and individuals. We're not quite 100% what the final figures. We've read a couple of articles with different figures. But just watch this space. I suppose if you're in small business, just keep a radar out. Some potential rebates. Largely for a lot of businesses, they're fairly modest. Between $150 and $300 seems to be the range. For individuals, once again, under the 1%er theme, it could be a rebate up to what have you got there, $300 potentially.
Just still waiting on the
householders. So 1% every little bit counts, but keep an eye out for the energy rebates there.
Great. And then there's also some changes that we've kind of known about coming through with employer contributions for employees increasing to 12%, so from 11.5% to 12% from July. And I guess similar to how we've had previous podcasts around interest rates and when they drop, great for those who have a home loan, maybe not so good for the retirees. And so with SGC or the superannuation guarantee contributions going to 12%, there's a win for employees. They're going to have more money going into their superannuation to support future retirement. But that's also an increase to small business or medium business on the expense side of things. So pluses and minuses.
Yeah, all businesses will wear that extra 0.5% from 1 July 25. That was what was legislated maybe 4 years ago. So this is the last legislated tranche for the increase. So there's no more legislation to go beyond 12%. So unless the future government announces that. So but that is definitely going to happen from 1 July this year, 12%. As you say, the winners are employees. The cost of labour effectively has gone up by 0.5% regardless of whether someone receives a pay rise from 1 July or whenever they get their pay rise anyway.
So something for small business to start thinking about if you need to budget that money. I suppose in terms of budgeting that cost as well, a lot of small businesses might accrue that in a bank account in their I guess their everyday account for that quarterly payment. My understanding is from 1 July 2026 that's likely to change as well.
Yeah, that's I think payday super is the term that people are banding around. So currently superannuation guarantee or your minimum employer super is due quarterly, as you mentioned. So the government have flagged that to move to payday, so every pay cycle you would pay employees super, which I don't think is a bad thing. It's just in practical terms from a lot of small business who may have relied on that sort of cash flow relief in deferring the super, that option won't be available. So important for small business owners to get their head around that, and I've been encouraging people to start to wean themselves off the quarterly payment, even that's minimum, and encourage them to at least go monthly. So it's the jump from quarterly to, if your pay cycle's fortnightly, then you'll be making fortnightly super contributions. With single touch payroll that came in a couple of years ago, then the loop in terms of reporting is very close now. So if you're not meeting obligations there, then you really, there's nowhere to run and hide now. So which is not a bad thing. It's just giving people the heads up. That's sort of, you need to be on top of your game in that space. I believe it's 1 July 26. There's a bit of work to be done. A lot of people use software like Xero MYB in small business. There's a bit of work to be done just to try to tease out the final specifications of how that will be done and some of the nuances around that. But yeah, you can pretty much largely say that that's definitely going to happen. So start thinking and planning accordingly.
Yeah, and is that really just aligning it with your existing staff's pay cycles, or is it it's going to be mandated that it's fortnightly as an example? So
my understanding at the moment is it's your pay cycle. So if you're weekly, fortnightly or monthly, then you'd be paying the employee and paying your super in the same cycle.
Yeah, so potentially incentive for those who are currently paying their staff weekly to maybe think about fortnightly.
Yeah,
or
that's right, a bit of a change for some people. So that's my understanding. So
great. Look, I think there's a little bit about business as well. I think that's enough about the individual. I guess on a business side of things, some changes to some of the tax write-offs that were being used.
So this is under the instant asset write-off, or small business being able to write off assets. So currently for FY24, we've got a 20,000 threshold limit. From the budget 12 months ago in 2025, they announced that would be extended for FY 2025. Just pointing out that is actually not actually legislated. The tip is that will be legislated in June under the new government when it's formed, if the pundits are right, that we'll have a May election and a new government. So all intents and purposes, highly likely, but it's not 100% guaranteed, just in case something happens. So we're talking about FY25, our current financial year, likely to be that it's be a 20,000 instant asset write-off. So just to clarify, so any item that's under 20,000, you can get 100% depreciation in the first year. So it's not the first 20,000. So if you buy a motor car for business purposes and it's $40,000, then normal depreciation, so small business depreciation rules will apply. So it's not the first 20,000, anything over 20,000. It captures more. Say if you bought a trailer for your work van, it was $6,000, then you get 100% tax deduction on that being under 20,000. This budget 2026 didn't announce any further extension beyond into FY26 on the threshold, which legislatively means that it'll come back to the normal default, which is $1,000. This whole aspect from the last 10 years has bounced around with so many different figures, but just, I suppose the facts are, we have currently $20,000 announced FY25 threshold test, no announced extension to that into FY26. So if you're sort of taking a punt, so to speak, if you're thinking of buying something that's under 20,000, FY25 is your better year. Bearing in mind my sort of previous caveat that it's not legislated, but likely to happen.
Yeah. Very good. Is there anything else you wanted to cover off on?
Oh, just from a small business land, we always sort of note the funding for ATO. So those of you in small business may have noticed an increased level of activity. Of us being on the MDH accounting, the tax agent side of it, we have noticed a lot more activity from the ATO in terms of either being more hard-nosed about debt collection, providing relief for small business owners, as well as a heightened activity to investigate certain activities. So I suppose not necessarily a bad thing, we just noted that there was extra funding for ATO, which predominantly will flow through to small business, but it can flow through property transactions are always on the ATO's radar, so their level of data matching from state-based property transactions in terms of the Titles Office is much stronger these days. So if you're selling an investment property, but it was sort of maybe not invested, like a family check and stuff like that, people sometimes think, oh, I don't have to pay tax on that because I never rented it out. Unfortunately not, you only get the primary residence exemption, and so some individuals may not have thought through that, and so a good planning opportunity. You and I both talk to people that are on top of that. They identify the capital gains tax from a sale of a property perhaps, and using superannuation as a strategy in that current financial year when they sell the property is a good sort of tip, I suppose, to take away.
Yeah, it can be a good tool, and certainly better to plan that ahead of time and go, what should we do proactively when you do decide to sell the property in 12 months, 2 years, not, hey, I've just sold this thing, how do I solve this between now and June 30? Because sometimes you are limited with what you can do and time frames. Yeah,
and unfortunately I sometimes get either existing or new clients come in, they've sold the property, and then they come and get their tax done, and it's too late once 30th of June's rocked around to do anything about that particular capital gains tax, and it gets lumped together, and it can be quite a lumpy number for some people.
Yeah.
So no new announcements there. It's just, I suppose, the level of vigilance both from a business and property transactions will be predicted to be higher with the extra funding that ATO have been given.
Yeah, and that's the key. No direct changes, but they're just going to have more resources to track things down and lift the bonnet on it. So very good.
Yeah, so I suppose overall, I think the 1% theme's a great one, Josh. There's lots of little things from a business perspective. Nothing really major in there for business. Some small wins under the cost of living umbrella. Some with energy, PBS, and tax cuts. And for younger people, certainly the HEX one, the discount there could be a substantial improvement in people's serviceability and that whole getting their first home or remortgaging and things like that. So
very good. Well, that's a wrap for today, and Michael and I'll see you in the next podcast.
Thanks, guys.